Hey guys, the Bank of England has just raised the base rate of interest by 0.25% to 5.25% here in the UK. On one hand, some people argue that the rate rises so far are enough and yet to feed through the UK economy more generally. On the other hand, other people argue that the Bank of England have been slacking pretty much and have not raised rates aggressively enough to contain inflation, which remains persistent. What do you actually think? For today's video, I want to explore what today's rate rise actually means for all our personal finances. What does it mean for your property, your mortgage, your debt? What does it mean for if you're a first-time buyer trying to get onto the property ladder? What does it mean for your investments, your savings, and all the various other areas of your personal finances? Now, as usual, I've made my notes and I'll be looking here at my computer to guide me to make sure that I am delivering absolute facts to you guys and making sure that today's video is actionable, as I do with every one of these updates. If you're really enjoying today's video, please hit that subscribe button to show some support to our channel. Now, having read the minutes of meetings from the MPC, the Monetary Policy Committee, the votes, the 9 individuals on that committee, they voted in this order. 6 people voted in favour of that 0.25% increase, whereas 3 people voted, 2 people voted actually that they wanted to increase it by 0.5%, and 1 person voted that they did not want to increase it at all. The 2 people who voted for a 0.5% increase, these were the words that were used. For these members, a forceful increase in the bank rate at this meeting would help to bring inflation back to the 2% target sustainably in the medium term to reduce the risks of a more costly tightening later on. What they're essentially saying is they wanted the rate rises to go even higher than the 0.25% because they see inflation remaining a problem in the very near future. Okay, let's just dive straight in. I want to start by looking at the UK economy, the various aspects of the UK economy. I'll be sharing what they've said and I'll be unpacking it in everyday words just so that you understand it and you can act upon it. Looking at GDP, it says here in the Monetary Policy Committee that the underlying quarterly GDP growth has been around 0.2% during the first half of 2023, 0.2%. They also said that bank staff expect the GDP rate of 0.2% to remain the same for Q2 and Q3 of 2023. Essentially what they're saying there with GDP is that nothing has happened, the UK is not growing, and as you see later on, there are currently no prospects of the UK economy actually growing. Okay, that's GDP. Now it goes on to say that quarterly GDP growth was expected to be weaker throughout much of the forecast period. Pay attention. And it says particularly during 2024 and at the beginning of 2025. Okay? An increasing degree of economic slack was expected to emerge from the middle of next year. And pay attention to this. Unemployment rates are projected to rise to just under 5% by Q3 of 2026. In simple layman's terms, what they're really saying here is that from a GDP and unemployment perspective, the future looks pretty bleak. And we expect unemployment to actually rise rather than go the other way instead. Now, looking at inflation, which has been the big topic in these conversations, it says here that the top line inflation, looking at inflation to June 2023, so they always look 12 months behind, the rate at the moment is 7.9%. And it says here that the annual private sector regular pay growth increased by 7.7% in the 3 months to May, materially above expectations. What they're saying here is that people are essentially asking for pay rises, understandably. So those pay rises rose a lot more than they expected. And as a result of that, will be feeding into the inflation numbers. Now, the 7.9% rate of inflation, CPI at the moment, interesting when you look at what's actually driving that. It says here that it reflects a falling contribution from energy. So energy prices are lower And then it says to a lesser extent, food prices, okay? So food prices, although they're declining somewhat, are not falling as quickly as the Bank of England would have expected, okay? It actually goes on here to say that the current rate of inflation for food is at 17.3%. The exact words they used were, they expect that, they're looking here, they're saying here that essentially food plays a large impact on the living costs of lower income families due to it making up a larger share of these families' budgets. And so they still see it as remaining extremely high, and they're watching food inflation to come down gradually. Now, a big part of the inflation numbers, looking at inflation, is an area known as services CPI, to which, although the number had declined gradually, it didn't really decline to the extent that they expected. And they actually say that services inflation is more of an indication of inflation remaining persistent, i.e. remaining a bit of a problem as time passes. So they are projecting, using the words, i.e. in terms of forecasts, they are projecting, the words they use is that services inflation will remain elevated in the near term. They're basically saying in the near future, we're going to expect this element of inflation called services inflation to actually remain higher than normal. Now, interestingly though, the more you pay close attention to what's being said, they keep referring back to this fairy 2%, this dream 2% number that is supposedly meant to help the economy grow and all these stuff and stay sustainable and so on. So they're forecasting that CPI inflation will return to 2% target by Q2 of 2025. Pay attention to that. Q2 of 2025, that's the second quarter of 2025. We're in 2023 right now in the summer, so Q2/Q3, But you remember, if you paid close attention to the news, maybe in the last 12 months, a lot of the promises were that this inflation rate will fall back to 2% by the end of 2023. So we are basically being told gradually that, you know what, that ain't gonna happen. Plus, the big focus, actually, if you think about it, was that growth was meant to be the big agenda for the UK. Have we grown? No. Are we forecast to grow? No. What's actually happening? In fact, we appear to be declining more than anything, or staying steady at best. Now, when you look at the global situation from an inflation perspective, it says here that consumer goods price inflation was declining, but service price inflation had remained strong. So we're seeing a similar trend. Although inflation is lower in the US and it's lower, broadly speaking, in the Euro area, central banks in those parts of the world, so the Fed and the ECB, are also still raising rates, which of course would encourage the Bank of England, although the UK is separate, would encourage the Bank of England to actually maintain their rate rise kind of policy. Looking at interest rates, they say here that the market implied path for interest rates will remain around 5.5% over the next 3 years. So take where we are now in 2023 and add 3 years to that. They're saying that they expect it to be an average, this is the base rate, guys, of around 5.5% for the next 3 years. Just pause for a minute and just think about what that means for your personal circumstances. Whether you're trying to go on a property ladder, whether you've got a mortgage, all those kinds of things. Just think about what that means 3 years from today. Okay? In summary, as I said, when you look at the UK economy, if I have to spell out the obvious, it's essentially that we've been promised a lot of things when it comes to UK economy growth, inflation falling down to 2%, unemployment declining, interest rates not going crazy, all these things. But not a lot of those things have panned out. In fact, none of them have panned out. All that's happened really is that interest rates have risen and interest rates will remain high for much longer. And the UK economy appears to be getting a lot worse. Let's look at what this means now for mortgages and rents. Now, if you are on a tracker or variable mortgage, you will see an instant increase when it comes to your mortgage payments, unfortunately. So I did a calculation using my calculator, which if you want to use it, feel free to download it. I'll point to it above and below. If you've got a £250,000 mortgage, for example, just for illustration purposes, that 25 basis points increase, that 0.25% increase, will result in around a £37 a month increase to your mortgage each month. Bear in mind the last time we had this increase in June, when they increased rates by 0.5%, you would have had to find around £71 a month. Now you're thinking about adding another £37 a month, which, you know, for families who are really struggling to earn more and to balance their budgets, is actually a very, very difficult time for a lot of households at this very moment in time. And I completely sympathize with that position. And I get that things are really hard. If you've got 100k in mortgages right now, it will mean around a £14 per month increase in your mortgage, you know, thanks to this increase in base rate by 0.25%. Now, question always is, should I be fixing my mortgage now if you're someone who still has a variable, rate mortgage at the moment? Should I be fixing like a tracker? To be honest with you, as I've said previously, this really comes back to whether you are, if you want to be able to predict your expenses every single month. I've always been a big fan of, fixed rate mortgages. And if you've been following our channel for a long time, you know that I've been talking about this since they started raising those rates back like almost 2 years ago. So if you really want to be able to predict your payments, a fixed rate mortgage might be the thing for you. I've gone and looked them up to see what sort of rates we are looking at right now. Okay, so as at August 2023, and I'm looking here at Money Facts, the website, although there's been a shift in some of the banks have reduced their mortgage rates slightly. Some of the major banks have reduced their mortgage rates slightly because inflation numbers came out a bit better than expected at 7.9%. As I mentioned earlier, the rates are still pretty high, okay? Let's say you were going to go and remortgage right now. The best 2-year fixed rates right now, the best sits at 6.69%. Compared, interestingly, even though they reduced some of the rates, compared to 6.04% back when I did this update in June, assuming you've got a 60% loan to value. And that assumes there are no product fees, and the provider that's offering that rate of a mortgage is nationwide as at this minute. Okay, looking at 5-year fixes, if you are trying to remortgage right now, again, the best rate for 5 years sits at 5.84%, assuming no product fees and assuming a 60% loan to value. Again, nationwide appears to be topping the list of providers. They don't pay me to mention them. I'm just doing it for illustration purposes. And I've been mentioning many other providers on this video, by the way. In no way am I, financial advice and all that. This is not what this is. I'm just trying to tell you the facts just so you can go and research it yourself. Now, if you are interested in the rates for moving home are a bit lower. So compared to remortgages, if you were trying to move home, for example, again, I looking here, I can see that their two providers are Nationwide and Gen H. Right? They're offering fixed rate mortgages right now for a 2-year fix at around 6.34 and 6.53% respectively. Okay? And that's assuming a 60% loan to value. Yeah. And it carries on that way. Okay? The key here though is if you are currently on a fixed rate mortgage, the big challenge you have is that you'll be coming out of that mortgage at a time when you've been paying potentially, historical low rates of interest, and then you're coming out onto these astronomical rates right now. And it's estimated that around 1.4 million people will be coming into that situation in 2023. Okay, so you want to be spending some time right now doing certain things. For example, budgeting strictly right now, or even considering overpaying on your mortgage. So you're knocking down on that capital element of that debt to prepare you for that shocking reality of your monthly payments going up. In fact, I've been running some scenarios right now. If I was in your shoes, use a mortgage calculator. There's loads of them on the internet, or you can use ours if you want. I linked to it. I mentioned I linked to it earlier. Feel free to grab it if you want, or find one online. But essentially, what you want to be doing is preparation and overpaying. Another question I've been getting a lot is, what if I'm struggling right now to pay my mortgage? What if these rates are going up and, what do I do right now? I fully understand this is causing massive anxiety for a lot of people who have mortgages. So I fully get it. And the key thing to mention is that, missing a mortgage payment is not just like missing paying your normal bills. This actually affects your credit record, your credit score, and that kind of stuff. So you really don't want to go and try missing payments. So what I would do is actually speak to your lender. So the options are, lenders are willing to actually help because they understand the situation. So consider getting yourself a mortgage holiday. Alternatively, and I don't really recommend doing this, but if you have to, then you have to. You can consider going on an interest-only mortgage. That benefits some people, but there are pros and cons. And alternatively, some people have had to increase the term on their mortgage as a way to cope in the meantime. But do please bear in mind that adds significant amounts of money to the amount you're going to be repaying over the term of your mortgage. So you want to, again, consider the pros and cons of making those decisions. Now, speaking to renters now, a lot of people who watch our channel are renting and trying to get onto the property ladder. If you're renting right now, it's likely that landlords who are struggling to keep up with their mortgage payments might pass on the effects of these increases to you potentially as a renter. So what if, one of the things that's come out lately is this option of 100% mortgage. We've made a video about it previously. Again, I can see where that can help people get onto the property ladder. And, if you think that will help you, I've made a video about it. I'll link to it below and above. Please go and check out that video and look at the pros and cons of such an idea as 100% mortgage. But as ever, I would never, that's just me. I wouldn't take on a 100% mortgage personally. I would always have some skin in the game, no matter how small. At least a 5% deposit put down, preferably 10, 15% or more. But I completely get that everybody's circumstances are very different. So please watch that video if you will find it useful. I think you will. So do try and watch it if you can. Now, as for first-time buyers continue to be priced out in this market, and a lot of mortgages are basically unaffordable for a lot of first-time buyers. Rates remain really high, although if you put down a much bigger deposit, you obviously stand a much better chance of getting much better rates. Now, here's something worth thinking about though. In every falling market where prices are falling, you might think, and obviously rates are rising in this scenario, there is always someone benefiting. You always have to remember that. So as a first-time buyer, one thing you might want to consider is, could I potentially benefit from buying a much cheaper property now, relatively speaking? Things are still high, still expensive, but cheaper than maybe in the last 6 to 12 months. Could I get a really good deal now, but feel the pain from an interest perspective for a season? Okay? This is something worth considering very strongly, rather than kind of going, I'm not going to buy right now. Okay? Now, I've always said, do your affordability checks, because everything comes back to affordability. And as I've said in previous videos, aim for around 25% of your net income max, ideally, to go towards your mortgage payments. Yeah. Now, looking at rates for first-time buyers real quick, 2-year fixed rates, again, looking here at Money Facts, assuming a 90% loan to value, currently sits at 6.64% with Nationwide and 6.78% with Gen H. 5-year fixes for first-time buyers, assuming a 90% loan to value, currently sits, the best you can get is 5.89% with Nationwide or 5.97% with Gen H. Okay. Now, if you put down a bigger deposit, so you went from 10% deposit to 15% deposit, the rates are materially different. Okay. The best rates for a 2-year fixed, assuming an 85% loan to value, is 6.78% with Gen H. And if you went for a 5-year fixed, the best rate you can get as a first-time buyer at 85% loan to value right now is with Nationwide at 5.89%. Let's move gears now and look at buy-to-lets. Okay. Again, I'm sharing this because a significant part of our audience are people who are investors in property, or people who want to become investors in property. Okay. And I would say that this season, this is actually a really brave thing to do, doing buy-to-let. But I know for sure, that there are interesting buying opportunities even in this situation right now where rates are rising. If you go and spend some time on Rightmove right now, you will see like the vast majority of properties on there are reduced. You will see it. You can even download like a Chrome extension that helps you see when properties have been reduced and what they've been reduced by, right? I've been keeping an eye on it, paying very, very close attention. And there are some really interesting property deals out there for those of you who are interested in that kind of stuff. But the key is really finding that sweet spot between rental income and pricing, right? Because ultimately all the bank cares about is can the rents actually cover and meet their stress tests and what have you, okay? Anyway, shifting gears, the rates that are available from a buy-to-let perspective are from a 2-year fixed perspective. I looked here, the best rates stands at around 5.99% with the mortgage works, okay? Assuming a 75% loan to value, but there's a shocking 3% arrangement fee attached to that. Just think about that. That is just literally like, whoo, that is robbery right there. 3% arrangement fee. However, you can actually get an arrangement fee that is not a percentage one. So you can get like a fixed fee type arrangement fee. Now, if you want to get a buy-to-let mortgage for 5-year fixed, the best rates out there right now are around 5.79%. Again, assuming a 3% arrangement fee. However, you can get a rate of 6.29% if you pay £1,495 as an arrangement fee, which you can obviously add to your mortgage if you wanted. Yeah. All that to say, the buy-to-let in this climate is very, very difficult. Traditional buy-to-let is very difficult. You need to find something where you are putting down a considerable amount of cash. So effectively what this means, if you think about it, is essentially it comes back to the old thing, which is the people who have the money profit from, situations like this where the economy is, unstable, prices are falling, but the people who can get in there are the people who can either joint venture with other people and pool funds together, or the people who can release money somehow and take advantage of opportunities or find like a distressed property and what have you. Anyway, moving on. Looking at debts more generally, anyone with a fixed rate personal loan or a car loan can rest easy in the the terms of their borrowing. If they fixed it, it's fixed. The base rate increase will not affect you and that kind of stuff. Okay. However, people who are on credit cards, although the rates on your credit card balances are not really meant to be driven by the base rate, banks can actually choose. They can actually increase your rates, but they'd have to actually tell you first. Okay. So credit card debt remains a major problem for a lot of people at the moment. So for those with hefty debts, you might have to consider 0% balance transfers, or just look at other ways in your life whereby you can accelerate payments, paying off that debt a lot quicker by making certain adjustments to your lifestyle. But a 0% balance transfer, which you can now get for as long as 34 months, but be super careful, is one way you could actually look to manage your kind of credit card debt situation. And obviously, if you've got much bigger loans, you may want to speak to a debt counselor. You've got the likes of Step Change are worth speaking to. The likes of Christians Against Poverty, CAP, are worth speaking to. And there are many other debt charities out there that are definitely worth speaking to try and get your debt situation resolved. We've made videos actually on how to destroy your debt, how to actually approach that debt systematically without the emotions often tied to it. I'll link to one of those videos above and below for you to go and check out. Shifting gears quickly to savings right now. Now, on the face of it, rate rises obviously are good for savers. Savers are savers, benefit from rate rises. That is really it. However, what's out there from a rates perspective is the best you can get right now is around 4.6% for an easy access savings account with Shawbrook and Paragon. Those are the rates right now, 4.6%. And this is a lot higher than in my last update. The highest was 3.71% back then. So effectively what's happening is there's been a much pressure on banks to actually stop being so greedy, and actually pass on some of those rate increases onto savers. Yeah, a lot of these banks have been basically hoarding anyway, I don't want to get, I'm starting to kind of lose it slightly, but you get my point here. But the rates are a bit better for the people who are saving money. Now, if you want to put your money into a 1-year fixed rate account, the best you can get right now is around 6.01%. You can get that from Kent Reliance as well as from Charter Savings Bank. Obviously, if these names sound really weird to you, go and do your research. Make sure you're putting your money into a reputable bank. I checked them. They've got FSCS protection, but I'm by no means recommending these companies, these banks to you. I'm just mentioning them for research and illustration. If you want to put money into a regular savings account, the best rate still remains 7% from First Direct. Now, the key thing to know with regular savers is that you're not really getting 7%, okay? Because you are putting money each month. Think of it, you put this much this month, you put this much. It's like a fixed thing you're putting each month. So all through, although it looks like you're getting like this 7% rate, what really happens is the bit of money you put in first is really what compounds and gets that 7% AER. But everything else after that gets less than 7% because of the timing of that money going into that account. Okay, just worth clarifying for the people who don't know that. Now, I want to just zoom out with savings because, when you think about savings, you're like, yeah, savings, this is great for savers. Savers are laughing, they're doing well. But if you think about it, inflation is still eroding the purchasing power of your money. Inflation, official inflation, CPI inflation, 7.9%, and you're looking here at rates for easy access, let's say 4.6%, that means that you actually have real negative returns, yeah? Because 4.6 take away that 7.9% for inflation gives you a minus 3.3%. If you think about it, what's really happening is actually psychological. We're being given some rates and like, oh, here, look, take this. You've been a diligent saver, blah, 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 blah. But on the other hand, you are quietly being robbed by those high inflation rates, okay? Just want to spell that out just so that we can really see what's happening here, which is that if you think about it, this comes back to the true reality, which is that in the last 10 years, savers are not really rewarded. Who gets rewarded? Asset owners. Yeah, that's right. People who own assets get rewarded because assets go up with inflation. But anyway, I'll leave that for another day. Personally, when it comes to saving, we're actually just, we're just investing. Anything that comes to, obviously outside of your emergency fund and all those things which you might keep in your, in your ISA or, instant access or wherever you keep your emergency fund. Actually, we've made a video for that. If you don't know where to put your emergency fund, I'll link to it below in the above. Go and check it out. We're investing in our ISAs, try and use our stocks and shares ISAs and our lifetime ISAs, max those out, max. And apart from that, trying to put money into other real assets because this is something for another. Actually, I should mention right now, if you're in London on Saturday this week, today's Thursday, on Saturday, we're meeting our community in our membership community. If you happen to be in London and you want to come and meet us for lunch with my incredible wife, Mary, in person in London, we're going to be talking about investing and think about the next 5 years and how we want to kind of navigate that. I'm going to link below and above to our community at Financial Joy Academy if you want to check that out. But it'd be good to see in person because the best things actually happen, the best ideas get shared in person. Now, let's look at investments. Now, stock markets are always forward-looking in nature. Well, yeah, they are forward-looking. So today's rate rises are not really going to already priced in. Not much actually happens. So our focus when it comes to investing actually remains the same, which is that we continue to invest globally. I'm already overexposed to the UK from a property perspective and what have you. So actually all my investments when it comes to stock markets, actually I'm keeping them outside the UK. I'm going buying global funds ex the UK or, developed world ex the UK because I don't want any more exposure. Doesn't mean you should do the same. I'm just telling you what I'm doing. Alternatively, we're focusing on dividend paying companies and making sure those are accumulating and compounding, But outside of those kind of typical stock market type investments, it's looking into other real assets, things that will either help to hedge inflation or things that will help to beat inflation over time. Because I know, I'll just say it now because I'm going to share my final thoughts. To wrap up, on a personal level, I want to read you what the Bank of England said on their website. It says here, they wrapped up by saying the MPC will continue to monitor closely indications of persistent inflationary pressures and resilience in the economy as a whole, including the tightness of labour market conditions and the behaviour of wage growth and services price inflation. If there were to be evidence of more then further tightening in monetary policy would be required. Effectively what they're saying here is if they see evidence, and this is like standard line, but I just want to just take away all that fluff and tell you like what they're actually saying. What they're really saying is if they keep looking through their, glass thing that looks into the future, if they keep seeing that inflation remains persistent, so like looking at like wages and prices for food and all the basket of goods basically, if they see inflation remains persistent, what they're really saying with this tightening, they will basically keep increasing interest rates. Now I want to just pause here for a minute because sometimes these interest rate updates can seem very transactional, and I've given you I've told you what's happened. Let's just zoom out for a minute, and this is probably another video, and I don't really want to waste any more time here, but you have to kind of ask yourself, how did we get here in the first place? How did we get to where we are? What's actually caused inflation? Is it all that money printing? Is it all that money that just showed up from nowhere? All those billions that showed up from nowhere, suddenly somehow printed and handed out to people? What's actually caused it? Yeah? And what does that mean for the future? What is your best guess or best estimate of what might actually happen in the next 5 years? Because I think as we think about personal finances, you need to have a position. You need to ask yourself, will inflation remain persistently high? Or will it fall to 2%? Will interest rates remain high? Or will it fall in the next 3 to 5 years? Because without making that decision on what you think those core elements will be, how on earth are you going to know what you're going to invest your money into? This is probably for another video, but I'll tell you what I think, just very briefly. I personally think that asset owners will continue to win for the next 3 to 5 years. Because in a world of high inflation or above average levels of inflation, what you really want to become is an asset owner and not just a saver. I'm not saying you shouldn't save your money. Save your money if you want. But I'm just saying, if you really want to play the game, and all of this ultimately, very sadly, is a game, because, anyway, I'm saying more than I really want to. But look, I'm just saying, you need to take a position. And the closer your position is to assets, the better you will turn out in the next 3 to 5 years. Okay? And in summary, UK GDP is not growing, it's flat or declining. Interest rates will remain higher for longer. Do your best in this season to look after your budgets and all those, bread and butter things that will make sure your emergency savings are being boosted, as the future seems pretty uncertain by these economic updates by the Bank of England. And as I say every single time I do these updates, I think there is always an opportunity even during a downturn. So don't see this as doom and gloom. See this as, you know what? Okay, this is what the worst case scenario is I now need to get a bit more creative. I now need to work a bit smarter. And I need to figure out ways of, living a lifestyle that means that I actually win this game over time. Because you will see over time, some people will emerge in the next 3 to 5 years as winners, and some people will emerge, sadly, as not the winners. Just as I bet you think back to 2020, you're like, oh man, I wish I did this, or I wish I did that. And I bet you when 2020 was happening, there was a great deal of uncertainty. But the people who made the moves back then are the people who have continued to benefit. Anyway, the next update will be on the 21st of September 2023. And I can pretty much guarantee what's going to happen. I'll be here, God willing, to do an update. But I can pretty much guarantee that interest rates will also rise again. Okay? And we may even have another surprise as we did last year, just before Christmas. But we'll wait and see. Other than that, do please look after yourselves. do please, even though things are challenging, try not to worry so much, because worry does more damage than we can actually physically see. Okay, it's more of an internal damage. And where you can, find those little things, those experiences that bring joy to your life, and have those experiences be at the center of your finances each and every week. Much love, and thanks for Mary and I. And hopefully see some of you on Saturday in person. Oh, and DM me on Instagram, by the way, if you want to know like how often we meet up, that kind of stuff. DM us at The Humble Penny on Instagram.